Listen, I want to show you one number. Get ready. $38.43 trillion. This isn't the budget of all Fortune 500 companies, not the value of all the gold in the world. This is the U.S. debt as of January 12, 2026. As of January 12, 2026, the total gross national debt stands at $38.43 trillion. Try to grasp this amount. A million seconds is 11 days. A billion seconds is 31 years. And a trillion seconds is 31,688 years. $38.5 trillion. And here's what's truly frightening: the speed. Over the past year, the rate of increase averaged $8.03 billion per day, $334.48 million per hour, $5.57 million per minute, or $92,912.33 per second, $93,000 per second. Literally right now, while you're reading this sentence, let's say 5 seconds, the U.S. added $465,000 in debt. By the time you finish listening to this video, $16.7 million. When I was in school in the early 2000s, the debt was around $6 trillion. It seemed enormous. Now it is 6.4 times larger, in just over 20 years. Compared to about 1 year ago, the total gross national debt is $2.25 trillion higher. Compared to 5 years ago, it is $10.73 trillion higher. Plus $2.25 trillion in 1 year. That is more than the entire GDP of Italy, or Canada, or South Korea, over 5 years, plus $10.73 trillion. That is like adding the economies of Germany plus Japan combined. On debt, $300,000 on your family. And here's the harshest part: $112,966 of debt per person, or $285,127 per household. Every American family nominally owes almost $300,000. Of course, you did not receive a bill for this amount, but this is your debt, as a citizen, as a taxpayer. The average American family earns $75,000 per year. Debt per family, $285,000, almost 4 times more than annual income. Imagine you take out a mortgage 4 times larger than your income. The bank would say, you are insane. But the government, it does exactly this. When will it be $39 trillion? Assuming that the average daily growth rate over the last 3 years continues, the United States will reach $39 trillion approximately on the 5th of April, 2026. The 5th of April, 2026. In 88 days from today. Not in 2030, not in 2028. In 3 months. It took more than 2 centuries, from 1776 to 1986, for the federal debt of this country to reach $2 trillion. But this year, it took less than 11 months for the federal government to add another $2 trillion. 210 years to accumulate $2 trillion. 11 months, the year 2025, to add $2 trillion. This acceleration is absolutely insane. How did we end up here? All right, let's do it quickly. How did a country with the largest economy in the world accumulate debt larger than its annual GDP? At the end of fiscal year 2001, the last fiscal year in which the United States government had a surplus, the gross federal debt stood at $5.8 trillion, about 55% of GDP. The year 2001, the last time the United States had a budget surplus, $5.8 trillion of debt, 55% of GDP. Bill Clinton was leaving office, having left a surplus. The future looked bright. Then the following happened. 2001 to 2008, George Bush. Wars in Afghanistan and Iraq, tax cuts, debt grew to $10 trillion. 2008 to 2009. Financial crisis, Lehman Brothers, bailout of banks, stimulus packages, recession, debt by the end of 2009, $12 trillion. 2009 to 2017, Obama, fighting the recession, Obamacare, debt by 2017, $20 trillion. 2017 to 2021, Trump, tax cuts in 2017, COVID -19 in 2020, money printing like mad, debt by the end of 2020, $28 trillion, 2021 to 2025, Biden, then Trump again, infrastructure, stimulus, tariffs, OB-BABA, One Big Beautiful Bill Act, $38.4 trillion. Over 24 years, the debt grew 6.6 times, from $5.8 trillion to $38.4 trillion. The debt ceiling is political theater. Here's how it works. Congress first approves spending. Military budget, $900 billion. Approved. Medicare, Social Security, infrastructure. Approved. Then the government spends the money, but revenues are not enough. Taxes collected are less than spending. Borrowing is required. And then comes the debt ceiling. This is the limit on how much the government can borrow. The debt ceiling, or debt limit, is a restriction introduced by Congress on the amount of outstanding national debt that the federal government can hold. Sounds logical, right? A limit on debt. But here's the irony. Congress has already approved the spending. The debt ceiling is not a decision of whether to spend or not, but a decision of whether to pay for what has already been spent. The debt ceiling does not authorize new spending obligations. It simply allows the government to finance existing legal obligations that Congresses and presidents of both parties adopted in the past. Imagine, you bought a house with a mortgage, you signed the contract, and then every month you vote again on whether to pay the mortgage. Absurd, right? But this is exactly how the United States handles its debt. And the wildest part, it has turned into a political weapon. 2011, Republicans in Congress, Obama as president, months of bargaining. The limit was reached at the last moment. Markets collapsed and Standard & Poor's downgraded the United States for the first time in history. 2023. The same thing. Republicans in the House, Biden as president. Again, negotiations until the last moment. Again, the United States credit rating was downgraded and government borrowing rates increased. 2025. Again. On the 2nd of January, 2025, the federal debt ceiling was reinstated at $36.1 trillion. The Treasury began extraordinary measures. Congress argued for months. In July, it was finally raised to $41.1 trillion. The Budget Reconciliation Act, adopted on the 4th of July, 2025, raised the debt ceiling by $5 trillion to $41.1 trillion. Every time, a threat of default. Every time, a game of chicken. And sooner or later... Okay, let us talk about what would happen if the United States actually did not raise the debt ceiling and declared default. First, an important point. Since the United States has never defaulted on its obligations, the scale of negative consequences from a default is unknown, but it would likely have catastrophic consequences in the United States and on markets around the world. The United States has never defaulted. Never. Since its founding in 1776, 250 years, always paid. This is the foundation of the global financial system. But let's imagine what would happen. Scenario 1. Technical default for a couple of days. The softest version. Congress stalls, the ceiling is not raised, the Treasury misses one interest payment. Within 2 to 3 days, politicians panic, quickly raise the limit, and the debt is paid. What happens? Day 1. The United States does not pay $50 to $65 billion in interest on bonds. The news explodes. United States in default. Stock market, panic. S&P 500 drops 5 to 10% in one day. Dow Jones minus 2,000 plus points. Worst day since COVID. Bonds. Treasury yields soar from 4.5% to 6 to 7%. Investors demand a risk premium. The United States is no longer a safe haven. Dollar collapses 3 to 5% in one day. Flight to gold, Swiss franc, Bitcoin. Day 2 to 3. Negotiations 24/7. President, Speaker of the House, Senate leaders behind closed doors. CNN, Fox run countdowns. Day 4. Congress votes. Ceiling raised, debt paid with a small delay. Consequences. CEA report found that after the debt ceiling standoff in 2011, mortgage rates rose by 0.7 to 0.8 percentage points for 2 months after the crisis, and auto and other consumer loan rates remained elevated for months. Even a short crisis has months-long consequences. Mortgages more expensive. Auto loans more expensive. Credit cards more expensive. Every family in the United States pays more. Plus, Republican brinkmanship led to stock price declines, reducing household wealth by $2.4 trillion, lowering the U.S. credit rating. $2.4 trillion disappeared from pensions, 401k accounts, savings, just because politicians played games. Scenario 2. Selective default, weeks, months, ceiling not raised. Congress stuck in a stalemate. Treasury forced to choose whom to pay. About $35 billion in payments on or around the first day of each month for salaries or benefits. For active military, federal and military retirees, veterans, and disability recipients. Between $5 and $9 billion in interest payments on or around the 15th day of each month. Imagine, the Secretary of the Treasury sits with a calculator. Revenues cover 70% of expenses. Who gets paid? Option A, pay interest on bonds, avoid technical default, but do not pay Social Security, military salaries, Medicare. 68 million retirees do not receive checks. 2.1 million military personnel do not receive salaries. Veterans without benefits. Chaos. Option B, pay Social Security and military, but do not pay bond interest. Technical default. Rating agencies downgrade U.S. from AAA to B, BB, or lower. What happens? Week 1, Panic in markets. S&P 500 minus 15 to 20%. Treasury yields 7 to 9%. Investors flee. Dollar drops 10 to 12%. Flight to euro. Gold, $3,500 plus dollars. Bitcoin. Oil jumps $30 to $40 per barrel. Fear, uncertainty. Week 2. Retirees storm congressional offices. Where's my money? Military protests. We defend the country for free. Companies start layoffs. Fear of recession. Mortgage and auto loan rates 8 to 11%. Housing market freezes. Week 3 to 4. U.S. ratings downgraded. Moody's, S&P, Fitch all say United States is no longer AAA. Foreign investors, China, Japan, Saudi Arabia, start selling treasuries, do not want to hold debt of a defaulting country. The Federal Reserve forced to buy bonds to stabilize the market, printing trillions. Inflation threatens to return. Month 2. Economy enters recession. Moody's Analytics report, issued in early 2023, estimated default could have macroeconomic consequences similar to the Great Recession. GDP down 4%, nearly 6 million jobs lost, unemployment above 7%, unemployment 7% plus, 6 million lost jobs, GDP minus 4%. This is not a game. These are real people losing homes, jobs, pensions. Scenario 3, full default, catastrophe. Worst case, political deadlock lasts months. The United States stops paying on all bonds. Full default. Honestly, this is so unlikely that I'm not even sure it is worth discussing, but let's do it for completeness. First, 24 hours. Global markets collapse. S&P 500 minus 30 to 40%, worse than 2008. Treasuries, no buyers. Yields 10 to 12% plus, if there are any buyers at all. Dollar collapses, minus 20 to 30% in a week. Gold, $5,000 plus dollars per ounce. Bitcoin, $200,000 plus dollars, flight to alternatives. First week, banking panic. People withdraw money, bank runs, banks close, like 1933. Pan Federal Reserve declares emergency. Prints $5 to $10 trillion to stabilize system. Government imposes capital controls, cannot move money out of the country. First month. Moody's predicted $12 trillion of household wealth lost, with stock prices falling by a third at the peak of the sell-off. Global recession. Europe, Asia, all fall. United States, 25% of world economy. Social unrest, people without salaries, pensions, benefits, protests, possibly violence. Long term, end of dollar hegemony. World moves to alternative reserve currencies. Euro, UN, gold, possibly BRICS currency. United States loses the exorbitant privilege, the ability to print the world S reserve currency and buy everything in the world. Honestly, this will not happen. Politicians are stupid, but not that stupid. Before allowing full default, they will do anything. Raise the limit, suspend it, bypass by law. But the fact that every couple of years we play chicken with $38 plus trillion of debt, that is already insane. You know what really scares me? Not the debt itself, but how much it costs to service it. At the beginning of 2026, the national debt of the United States reached approximately $38.5 trillion, a level previous forecasts had placed closer to 2030. Annual interest payments, which were about $345 billion in 2020, are approaching $1 trillion. $345 billion, 2020. Nearly $1 trillion, 2026. Almost triple in 6 years. For context, U.S. military budget, $900 billion. Medicare, $800 billion. Soon, interest payments will become the largest budget item. Paying interest is like flushing money down the toilet. You get nothing in return. You do not build roads. You do not treat people. You do not defend the country. You just pay bankers for money borrowed earlier. And here's what's terrible. Since the summer of the 2020 pandemic, interest rates have risen to roughly the same levels as before the financial crisis of 2008. How long higher rates, which will add a projected $2.5 trillion in debt service costs over the next decade, may persist, is an important macroeconomic question. Plus, $2.5 trillion in interest costs over 10 years, just because rates are higher. If rates rise further, from 4.5% to 6 to 7%, debt service will be $1.5 to $2 trillion per year, more than the entire defense budget, more than Medicare. How to pay? Only 3 options. Cut spending, political suicide. Raise taxes, political suicide. Borrow even more, death spiral. Guess what politicians choose? Correct, number 3. The real question is not if, but how. Look, I don't think the United States will declare default in the classic sense. There will not be a moment of, sorry, we are not paying. But there are other forms of default. Soft, quiet, more insidious. Form 1. Inflationary default. Remember I mentioned $38.4 trillion of debt? Here's the trick. If the debt is in your own currency, which you print, you can cheat. Print money. Inflation, debt is devalued. Example, you owe $100,000. Inflation 10% per year for 7 years. After 7 years, your debt in real terms is $50,000. You win. The United States can do the same. Allow inflation 5 to 7% for a decade. Debt in nominal terms is still $38 trillion, but in real terms, half. Problem? Inflation kills ordinary people. Wages do not keep up. Prices rise. Middle class gets poorer. But government debt melts. Form 2, financial repression. The government forces banks, pension funds, insurance companies to buy treasuries at low rates. Capital control. Cannot invest abroad, only in U.S. bonds. Yields artificially low. You get 2% on bonds, but inflation is 5%, minus 3% real yield. Your savings shrink, but the government pays less on debt. Sounds like conspiracy theory? This really happened after World War II. The United States and the United Kingdom did exactly this to pay off war debts. Form 3, restructuring. We cannot pay. Let's negotiate. Stretch deadlines, reduce interest, change terms. Technically not default, but de facto. Bondholders lose money. When will this happen? Here's the sad truth. The system can last longer than you think. Japan has debt 260% of GDP, has lived with it for 30 years, rates near zero. Italy, Greece, debt's 150 to 200% of GDP. Somehow, hold on. As long as people believe in the United States' ability to pay, as long as the dollar is the reserve currency, as long as foreigners buy treasuries, the system works. But there are triggers that can break it. Trigger 1, loss of confidence in the dollar. If China, Japan, Saudi Arabia decide enough of holding treasuries, they start selling. Yields soar. Servicing the debt becomes impossible. The world can be sure of only one thing. No one knows how the United States will ultimately handle the growing national debt and what the consequences of these measures will be. Trigger 2, interest rates. We already discussed. Rates 6 to 7%, debt service $1.5 to $2 trillion. Impossible without dramatic cuts or tax increases. Trigger 3, geopolitical crisis. War with China. Middle East explodes. Europe in chaos. Flight to safe assets. But if the United States is also in chaos, where to go? Gold, Switzerland, possibly even Bitcoin. Trigger 4, legislative foolishness. In 2025, the One Big Beautiful Bill Act, OBBBA, was passed. CBO estimates the law will add $3.4 trillion to primary deficits, $718 billion in interest costs, and a total of $4.1 trillion to debt by 2034, plus $4.1 trillion from one law. Huge tax cuts, partially offset by spending cuts. If temporary provisions of OBBBA become permanent, likely, the law will add $5.5 trillion to debt. Politicians continue digging the hole deeper. What should an ordinary person do? Okay, practical. If you are not a billionaire with offshore accounts, what to do? Do not keep all eggs in one basket. Diversification. Dollars, euros, gold, real estate, stocks, Bitcoin. Spread the risks. Gold and hard assets. If the dollar devalues, gold rises. Real estate with fixed mortgage. Also protection. Debt devalues. Asset remains. Gold now $3,000 plus. Could go to $4,000 to $5,000 if confidence in the dollar falls. Fixed rate debt, your friend. If you anticipate inflation, fixed rate mortgage is advantageous. You pay in devalued dollars. Bought a house for $500,000 at 3%. Inflation, 7% per year for 10 years. Your real debt halved. You win. Skills matter more than money. In a crisis, skills, your insurance. Can repair, build, program, treat. You will be in demand. Money may devalue. Skills? No. Do not panic, but be ready. Cash reserve for 3 to 6 months. Not all in the bank. At home, in case of bank run. Not all money, but part. Follow the news. When the next debt ceiling crisis starts, pay attention. If politicians really get stuck, move some out of stocks, buy gold, be ready. Next debt ceiling, $41.1 trillion.